Ladies and gentlemen, welcome to the first of the afternoon sessions for the European Mining Forums. Our first speaker, Mr. Paul Tomory, he's President and CEO of Centerra Gold. Paul, welcome.
Thank you.
May I start with the first question, please? Centerra, obviously fairly a substantial gold company, large market cap. You have a very strong cash position, no debt, growth pipeline from memory. I confess I'm a base metals analyst, but you have a bit of moly, which is always good, and copper, always good. What's the strategy over the near term in terms of unlocking some shareholder value there, please?
I always begin with a bit of a retrospective. People still do associate Centerra with the Kyrgyz mine, Kumtor. That's long gone. So Centerra is out of Central Asia. And what we've been doing over the last 2-3 years is clarifying the portfolio and advancing studies on the entire portfolio. And we're at an inflection point here where all of our assets now have a path forward, and this page summarizes it. Our cornerstone asset is Mount Milligan, 20-year mine life, copper, gold in British Columbia, with a lot of potential beyond there. We've got the Öksüt mine in Turkey, pure gold, fairly straightforward operation, mine life until at least 2930. We're looking at an extension there. Goldfield is a project in Nevada that we're advancing. We just greenlit that in July. And then Kemess is our most important project, another big copper gold mine in British Columbia, a past producer with relatively low execution risk. The main message here on strategy, and if you look at our share price, we've really performed well over the last 6-8 months, but we believe that there's a lot of room yet to grow. We believe we traded a discount, principally because there was not definition around the assets in the portfolio. So the strategy has actually been to daylight what each asset could be and then embarking on a path of execution. And the last point I'll make is we have a very strong balance sheet, and we're able to afford all of these projects quite easily at prices well below spot.
Great, thank you. Share price has done very well in the last 8-9 months. I think you've outperformed, but you're still trading at a discount. I should say, global mining research, our firm, we actually cover Centerra. So PNAV is still not quite there. What is the reason for this, and how can you overcome it?
So we, on a consensus basis, so not using our numbers, but using analyst numbers, using consensus gold prices of 3,300, we trade at the lowest multiple in our peer group. You can see it here on the slide. There are reasons for that. And as you mentioned, our share price has been trading up. So I think each of the key drivers of the low valuation multiple are reducing in their influence. But here's the rough way I characterize it. Number one, as I said, the portfolio was unclear. There was not a path forward on a lot of our assets. Mount Milligan had a much shorter mine life. The projects were on hold. The molybdenum business was on care and maintenance. So there's a lot of confusion around the portfolio, especially after the exit from Kyrgyzstan. We're bringing clarity to that. So that's valuation disconnect driver number one. Number two is we do have a molybdenum business. We are reopening a mine. I'll come back to it a little bit later, but we're reopening a past producer in Idaho. And going back 2 years ago, the molybdenum business represented 40% of our asset value. That's now down to 10%. And in fact, molybdenum is in a very bullish part of its cycle. So it in itself is an attractive metal right now. So there was a discount associated with the molybdenum exposure. It was 40% of our NAV. Now it's 10%. Again, it's wearing down. And the third driver of what I think is the valuation disconnect is when gold started to run here in the last couple of years, especially say 18, 24 months ago, the immediate money poured into names with high free cash flow yield. So immediate production impact. We do generate good cash flow. We have good leverage to gold price, but we are also reinvesting very heavily in our assets as evidenced by our pipeline. So the drivers of disconnect have been molybdenum, clarity around the portfolio and its complexion. And last is a switch from hunger for free cash flow yield to more value-based names. We believe each of those is reducing in impact, and we believe we're going to continue to re-rate as we execute on our plan.
Okay, you touched on an important point there. In terms of capital allocation, you have $500 million cash in your balance sheet, no debt from memory, very little, positive cash flow, of course. How are you thinking about capital allocation going forward?
This is obviously a key thematic for the entire industry with what do you do with the windfall cash flows right now. We have $500 million, just over $500 million of cash in the bank. I showed earlier that we have development projects. We have Thompson Creek, we have Goldfield, Kemess. We can very easily afford to build those with our existing liquidity. And in fact, at current metals prices, we don't even dip into our cash. We are able to fund the projects out of operating cash flow. And so when we look at the cash flow that we're seeing, our ability to afford our projects, and given our conviction in the discount in our valuation, we're putting a lot of money directly back to shareholders. We pay an annual dividend, and over the last 18 months, we've really been ramping up our buyback. Last year, we did nearly $100 million, and this year, we intend to do at least that amount again, demonstrating our very strong conviction in the share price. So principally, it's reinvesting in our projects, it's giving money straight back to the shareholders, but also investing in gold, and we do that through exploration within the portfolio, looking at expansions to our existing ore bodies. I'll touch on it a little bit later. Our ore bodies are huge and have room to grow. And we're also investing in juniors. We see compelling value in having a logical approach to our portfolio and our juniors, and we've made strategic investments both with developers and early stage explorers. So putting money to work in the commodity where we operate.
Okay. One of it, you guys have been fairly busy in the last few months. January, you published your Chemis PEA. Could you very briefly give us a bit of a walkthrough, a run-through of that, and how it contributes to your longer-term growth of production profile?
I think Chemis is a bit of a game changer. Let me take a step backward here on valuation. When we look at our market cap, we subtract the cash, we get our enterprise value. We believe that Mount Milligan alone, at prices below spot, accounts for our enterprise value. So when you're buying our stock, you're buying Mount Milligan and everything is for free. The second most important asset in the portfolio, and I think this is transformational for us, is the Chemis project. Chemis is a past producer, 50,000 ton a day process plant, a camp, power line, airstrip, all the infrastructure in place. If you were to build it new, it would be $4 to $6 billion of a greenfield build. We did a PEA. We identified a starter mine life of 15 years. And I say starter because this production profile on the slide mines out less than half of the total resource. So we're beginning with a relatively straightforward scope of an open pit and a conventional underground. And the capital ticket is under $800 million. So it's a very modest capital ticket. You can see in the pictures, as I said, past producer, most of the infrastructure already in place. So the capital is going into extensive refurbishment in the mill, in the tailings area, in the camp. But we are also allocating capital to the development of a new mining area. The area that we propose to mine here as a cross-section is located approximately 5 kilometers away from the process plant, and we need to essentially develop that area. This is what I spoke of, and this is perhaps the most exciting thing about Chemis, is you can see the PEA proposes to mine out what you see there as an open pit. It's almost no strip, very low strip, very little waste, in conjunction with a higher grade underground approach with a conventional mining method. The gray blobs are our current resource inventory. So the 15-year mine life that we have in the PEA mines out only the open pit, the easily to access open pit, and a portion of the underground. As we advance further studies, and as the years go by, we're going to do more drilling. We have another nearly 2 million ounces of gold equivalent down here. That's not in the current plan. We're going to drill in this zone here, see if we can connect mineralization, see if there's continuity, and then potentially consider a ramp down concept over here. And then to the west, keep drilling, see if we can fill in that saddle zone, expand into the deposit we call Nugget. So there's both open pit expansion potential and underground. So as you're a base metals analyst, you know these porphyries can have decades and decades of mine life. We have an initial 15-year mine life, and we're very confident through the conversion of some of these inferred resources and with continued drilling that this could have 20, 30 years of mine life. Again, copper, gold in British Columbia on a relatively de-risked asset. Most of the permits are in place, and we have existing agreements in place with First Nations. So relative to other projects, a lot lower risk. It's never without risk, but lower risk.
Okay. Actually, you mentioned Mount Milligan. Again, you've been busy, a new PEA, PFS coming out. What's, again, the highlight there, please, and what are you focusing on?
So Milligan is our cornerstone asset. We released the PFS in September, and you can see 20-year mine life here. Roughly split in value between copper and gold, with a relatively low all-in sustaining cost. We're in the $1,000 to $1,500 range. This is a very low-cost mine. And the other thing I'll add is both Mount Milligan and Chemis are relatively insulated from oil price inflation. Both mines will Milligan uses it, Chemis will use it, hydropower, very, very cheap hydropower. And both mines are relatively low strip, so the diesel burden isn't as great as it might be for some other mines. So we have a 20-year mine life. We're fully permitted to 2035. We just received permits on an expedited basis from the government of British Columbia. And as I said, this mine is in operation. It's our cornerstone asset. If we go to the next slide, this is perhaps the most exciting thing about Mount Milligan. This is the current mining surface here. This next line is the end of year 2025 reserve. That's mine life for 20 years to 2045. This is mine life to 2045. We have another 200 million tons of inferred and indicated, which would support another 10 years of mine life to 2055. And we continue to drill to the west and at depth. We're very confident that this mine could have 30, 40, 50 years of mine life. Again, copper gold in British Columbia. So Mount Milligan is our cornerstone asset, and it is operating. It had a really good year last year, and given commodity prices, we're looking for very strong cash flows this year.
Okay, great. Moving on to Turkey. Life of mine optimization at Öksüt, how's that going? When do you expect to complete it? Do we have a timeline on that, please?
So our second production gold asset is in Turkey. It's a straightforward oxide heap leach. And current mine life ends in 2930. And what we're working on right now is a combination project where we would look to extend the mine life by addressing lower grade oxides. The higher gold price does allow for that. But this mine has reconciled very positively since inception, and the inventories in the heaps are much greater than initial estimates had shown. So we see a significant project in a drawdown leach. So what we're doing is we're working on a joint study on oxide pit expansion potential combined with residual leaching, and we will be putting that study out at the end of this year, and we're expecting to add 2 to 5 years of production life.
Okay, great. You announced the decision to proceed with Goldfield project late last year. Is there any update on that, please, and how is the project going?
So we are proceeding with Goldfield. Goldfield is another relatively straightforward oxide heap leach project. It's in Nevada, one of the most friendly mining jurisdictions in the world. The total capital ticket here is $250 million, very affordable in our overall liquidity profile. And as I said, very friendly mining jurisdiction. The project is advancing. We are awarding long lead time procurement packages, and this summer we will see early works being initiated. So as of right now, the project is on plan, and we're aiming for first production in 2028.
Great, thank you. Okay, a bit closer to my heart. Molybdenum. How is the update on the Thompson Creek restart progressing? Latest developments there, please, too.
So let me talk first about molybdenum as a metal. We're here at a gold forum, and we're talking about molybdenum. As I said, it's about 10% of our total asset value. Molybdenum is used to alloy steel in high-performance applications, high temperature, high pressure, high cyclic fatigue, and is extensively used in liquefied natural gas, in pipelines, nuclear, defense, and aerospace, all things which are very thematic right now. In addition, we have an American business model. We have a mine in Idaho, a roaster in Pittsburgh, and the current U.S. administration's policies around industrial development, particularly in the steel supply chain supported by tariffs, has created a very attractive business model for us. So in short, what we're doing is we're reopening a past producer located in Idaho, the Thompson Creek mine, $450 million of capital. We're about halfway done. First production is next year. And the concept is to take the concentrate from the mine, truck it to Pittsburgh, and feed it to the roaster that we own over there. As I said, the price of moly has really traded up on very attractive fundamentals, both on the supply side. A lot of molybdenum comes out of copper mines, and the copper mines are just not keeping up with their production. And especially on the demand side, particularly in the U.S., we've seen demand go up. So the price of molybdenum has traded up from $20 to $28. Project is going well, on track for first production next year.
Great. Time for one last question from me. Certainly from the sell-side analyst point of view, always important. What are the catalysts that you'll be announcing, please, in the coming 12 months? What should the investors be looking for, please?
We are focused on execution right now. So we've outlined a path forward for all of our assets. As I said, we've traded up substantially over the last 8 months. We think there's room for that valuation gap to close, and it's all on execution. So it's really delivering as per the plan at our production assets and also at our projects. And as I mentioned, everything right now, all of our projects remain on track, on budget, and on time. So it's simply, the catalysts are principally delivery-related, milestones on projects, and of course, as I mentioned earlier, the study at Turkey for the life of mine extension.
Thank you. We're out of time. Apologies.
Thank you.
So, ladies and gentlemen, thank you for your attention. Let's thank Paul for his presentation. Thank you.
Thanks very much.